Welcome back to the channel. Today we're diving deep into a strategy that many investors overlook, yet it's the backbone of wealth building for institutions and long-term investors alike. We're talking about SCHD, the Schwab US Dividend Equity ETF, and why it represents one of the most compelling opportunities in the current market. If you're tired of chasing the latest hot stock or jumping into volatile sectors hoping for a quick gain, this video is for you. By the end, you'll understand why disciplined, systematic investing in quality dividend stocks isn't just boring. It's how the smart money actually builds generational wealth. So grab a notebook, because I'll walk you step by step through the math, the strategy, and the blueprint you can apply immediately, regardless of your account size or experience level. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. Let's start with the numbers. SCHD currently trades at a price-to-earnings ratio of 15.6. Compare that to the S&P 500, which is hovering near 28. That's nearly a 44% discount. And here's what makes this really interesting. These aren't just random companies. These are businesses that have increased their dividends year after year, even through recessions. Now, think about the average retail investor. Many are chasing the latest momentum stocks, trying to get rich quick on whatever is trending. Meanwhile, institutional investors, the people who manage hundreds of millions of dollars, are quietly pouring cash into dividend strategies. This is not coincidence, it's deliberate positioning. And understanding this positioning can allow you to move with the smart money instead of against it. Here's why that matters. The market is obsessed with growth. Stocks promising massive returns dominate headlines. Everyone wants the next explosive 10x story. But that obsession creates a huge valuation gap. SCHD's holdings, pharmaceutical companies, energy firms, consumer products, are trading at significant discounts because most people are distracted, chasing excitement. Institutions, however, understand that markets rotate. Value will eventually outperform growth. Cash flow will eventually beat hype. Recognizing this rotation is where opportunity lies. Now, let's break down the math, because this is where the story gets powerful. SCHD currently yields 3.8%. Most investors hear that and think it's too low compared to some flashy 8% or 10% yield, and that's exactly why they often underperform. They're chasing short-term high yields that look impressive on paper but can collapse during downturns. Here's the kicker: that 3.8% isn't static. SCHD's dividends grow at roughly 10% annually. Let's do a simple example. If you buy shares today yielding 3.8%, in 5 years your effective yield on cost grows to about 6%. In 10 years it's 10%, and by 15 years you're looking at roughly 16% yield on your original investment. This is the strategy institutions use. They aren't chasing headline yields today, they're building high yields over decades. Compare that to a stock offering 10% yield today, which may cut dividends during a recession. SCHD, on the other hand, has increased payouts for 13 consecutive years. Can you find a high-yield stock with that kind of proven track record? Probably not, at least not consistently. This is the fundamental difference between hype-driven investing and disciplined wealth building. You're not trying to hit it big tomorrow. You're letting mathematics, patience, and compounding do the work for you. Let's talk about what the professionals see that most retail investors miss. SCHD has extremely low fees, 0.06%. That's $6 annually for every $10,000 invested. Compare that to actively managed funds charging 1% or more, $100 per $10,000. Over decades, those fees alone can cost tens or hundreds of thousands of dollars. Additionally, the quality of SCHD's holdings is impressive. Roughly 85% of the companies have grown their dividends for at least 10 consecutive years. These are proven, reliable cash flow machines. Professionals aren't speculating, they're betting on consistency, stability, and growth, and the data supports it. Over the past 3 years, net flows into SCHD have exceeded $22 billion. This is serious conviction from institutions who have survived multiple market cycles. They're buying quality at a discount, reinvesting dividends, and holding through volatility. This is the classic institutional playbook. Meanwhile, retail investors chase excitement. High-yield stocks that might cut payouts, volatile tech darlings, or crypto and options promises that rarely materialize. Institutions aren't gambling, they're being patient and disciplined. and the market rotation from growth to value is inevitable. Those who act early benefit. Those who wait often buy at the top. Now, let's get practical. Here's a 3-level strategy that works for investors at any stage. Monthly automation. Start small and consistent. Even $200 or $500 per month can be enough. At current prices of roughly $27 per share, $500 buys about 18 shares per month. Enable automatic dividend reinvestment. Every dividend purchase buys more shares, which generate more dividends. The magic of compounding. With 10% dividend growth, you could see over $800 in passive income annually by year 10 without doing any extra work. The key here is consistency, not timing. You don't need to predict the market. You just need to stick to the plan. Lump sum acceleration. For those with larger capital, deploy $10,000 to $25,000, but spread it over 3 to 6 months to smooth volatility. $10,000 at 3.8%, yield starts generating $380 annually immediately. With reinvestment and dividend growth, that grows substantially. By year 5, you could see $500, $600 annually in dividends, plus capital appreciation. This approach accelerates income growth, leveraging both yield and market appreciation while maintaining a disciplined entry strategy. Core plus concentration. For experienced investors, combine SCHD's broad exposure with focused bets. A 3-tier allocation could look like this. 40% in SCHD for diversification across 100-plus dividend-paying companies, 30% in concentrated positions within SCHD's top holdings, Merck, Bristol-Myers, Chevron, where you have strong conviction, 30% in high-conviction dividend growers outside SCHD, like Realty Income or Enterprise Products Partners. This combination allows institutional-grade diversification while capturing concentrated growth opportunities. Your portfolio yield could reach 4.5% to 5.5% while maintaining capital growth potential. Here's the truth. The difference between investors who build generational wealth and those who don't isn't intelligence. It's discipline. It's the ability to invest during panics, reinvest dividends, ignore short-term hype, and embrace mathematics over emotion. Financial influencers thrive on excitement. They sell high-yield stocks that may crash, crypto promises that expire worthless, and options that burn cash fast. Their income comes from clicks, not from building real wealth for you. Institutions, on the other hand, profit quietly, steadily, and over decades. When the market panics, they buy. When prices recover, they reinvest. They don't chase FOMO, they follow strategy. And that's exactly what gives them the edge. Let's translate this into action you can take this week. Open a brokerage account offering commission-free ETF trading. Fidelity, Schwab, or Vanguard all qualify. Calculate a sustainable investment amount from monthly or quarterly contributions. Consistency beats large, irregular investments. Execute your first purchase in SCHD and enable automatic dividend reinvestment. Set up recurring investments and then close the app. Stop checking prices daily. Your focus is on long-term compounding, not short-term fluctuations. The signal is the dividend growth and the power of reinvestment. Ignore the noise and let mathematics work for you. Right now, the valuation gap between growth and value is extreme. Dividend stocks are trading at historically rare discounts. Institutions see this clearly. They're positioning now to capitalize on the rotation. You have a choice. Position alongside them when prices are discounted, or wait until retail catches up and pay 30% more. Your decision today directly impacts whether you profit from this cycle or finance it for others. This is why disciplined long-term investing in quality dividend-paying companies like SCHD isn't just a safe bet. It's a strategic move that builds wealth reliably over decades. To recap, SCHD trades at a deep discount versus the broader market. Its dividend yield of 3.8% grows around 10% per year. Institutional investors are moving billions into dividend strategies while retail chases momentum. A simple, disciplined investment strategy, monthly automation, lump sum deployment, or core plus concentration can build significant passive income. The key is consistency, reinvestment, and ignoring hype. Generational wealth isn't built chasing headlines. It's built quietly, patiently, and mathematically. Follow the institutional blueprint. Buy quality at a discount, reinvest dividends, and hold. Over time, this strategy compounds into an income machine that outperforms short-term speculation every single cycle. So take action this week. Open your account, decide your contribution level, make your first purchase, and let time do the rest. Discipline, patience, and mathematics are far more powerful than luck or hype. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.